Two people opened their retirement accounts this morning. The first person is probably that guy at work who somehow manages to bring up his portfolio in every conversation. This year, his account is up over 95%. Why? Because he's loaded up on Nvidia stock. For months, he's been telling everyone that artificial intelligence is changing the world and that anyone who isn't investing heavily in AI is missing the opportunity of a lifetime. The second person is you. You took the traditional route. Years ago, you started buying a simple S&P 500 index fund. You don't spend your evenings analyzing charts. You don't follow financial news every hour. You don't chase hot stock tips. You're doing what responsible investors are supposed to do. And your account is up too. Maybe not as much as your coworkers, but you're still making money. Here's the surprising part nobody talks about. You own Nvidia as well. In fact, there's a good chance you own far more Nvidia than you realize. You may even own more Nvidia than hundreds of other companies inside your so-called diversified portfolio combined. You just never noticed. My name is Della, and I've spent an unhealthy amount of time digging through market data, index fund structures, and investment math to understand what's really happening beneath the surface of today's stock market. And if you want to understand why some of the world's most successful investors are quietly becoming more cautious while everyone else celebrates new market highs, make sure to subscribe and hit the like button. Because today we're going to uncover what's actually driving this market and why so many investors may be walking straight into a situation they don't fully understand. Now, this isn't another video predicting an imminent market crash. Markets rise. Markets fall. That's normal. What's interesting is something else entirely. It's the fact that many people believe they own 500 different companies when, in reality, their portfolio is heavily dependent on a handful of stocks. Let's start with what's actually happening. Because the headlines make this far more confusing than it needs to be. Right now, the S&P 500 is hovering near record highs. The Nasdaq continues setting new records. And the Dow Jones recently climbed back above 51,000 points. If you've been consistently investing into your retirement account month after month, you're probably feeling pretty good. And honestly, you should. But there's one major misunderstanding almost everyone has. People see the index climbing and assume that means all 500 companies inside the index are thriving. That's not what's happening. Today, just 7 companies account for roughly 36% of the entire S&P 500. 7 companies. That's it. Nvidia, Microsoft, Apple, Alphabet, Amazon, Meta, Tesla. Add a few more of the largest names, and nearly 40% of the entire index is concentrated in only 10 stocks. Think about how dramatic that shift really is. Back in 2016, those same 7 companies represented only around 13% of the index. Today they're closer to 36%. In less than 10 years, their influence has nearly tripled. Which means when most investors buy an S&P 500 index fund, they're not getting the kind of diversification they imagine. They're effectively buying a portfolio dominated by a small group of mega-cap technology companies, with hundreds of smaller positions filling out the rest. And in 2025, those 7 stocks generated roughly 44% of the total return produced by the entire index. Almost half. Even more surprising, Nvidia by itself accounted for approximately 1/5 of all market gains. One company. One stock. Responsible for about 20% of the performance inside a market that millions of Americans rely on for retirement. So when I say you may own 7 stocks without realizing it, I'm not exaggerating. I'm describing how the math actually works. Go ahead and check your retirement account. Seriously. Take out your phone. Open your investment app. Look at your largest holding. If it says something like Vanguard 500 Index Fund, Fidelity 500 Index Fund, or any target date retirement fund, congratulations. You're a Nvidia investor. A fairly large Nvidia investor. Did you actively choose that position? Probably not. But because of how market-weighted indexes operate, the position grew larger and larger automatically. The index made that decision for you. Now, having a concentrated market isn't automatically a disaster. Concentration becomes dangerous only when something starts to break. Which leads us to the next question. How expensive have these companies actually become? And that's where the numbers start getting uncomfortable. So, how expensive is the market right now? There are dozens of ways analysts try to answer that question, but one of the simplest measures has been around for well over a century. Without getting buried in financial jargon, this metric basically tells you how much investors are willing to pay for every dollar of corporate earnings. Historically, going all the way back to the late 1800s, that number has averaged around 17. Today, as of mid-2026, it's sitting close to 40. Let that sink in for a moment. Investors are paying nearly $40 for every single dollar of earnings being generated. And in the past 145 years of market history, there's only been one period when valuations were even higher. Late 1999. Right before the dot-com bubble burst. The same bubble that eventually wiped out roughly 80% of the Nasdaq's value over the following few years. What's even more remarkable is that before the infamous crash of 1929, the valuation level was around 32. Today we're hovering near 40. In other words, by several historical measures, we're currently looking at one of the most expensive stock markets America has ever experienced. But let's examine another metric. Imagine taking the combined value of every publicly traded company in the United States and comparing it to the size of the entire American economy. In simple terms, we're asking a basic question. Are stocks becoming more valuable than the economy that supports them? Right now, that figure has climbed to approximately 235%, the highest level ever recorded. For comparison, before the dot-com collapse in 2000, the number was around 146%. Before the financial crisis of 2008, it was roughly 110%. Today, public stocks are worth more than twice the value of the entire economy producing the goods, services, and profits behind them. Think about a local restaurant. Now imagine investors deciding that the restaurant is worth more than the entire city block surrounding it. Eventually something has to reconnect with reality. And that's exactly why so many analysts are asking the same question. Why are investors willing to pay these kinds of prices? The answer is surprisingly simple. Artificial intelligence. At the moment, a massive portion of the market's optimism rests on one central belief. The belief that AI will create such extraordinary productivity gains that today's record-breaking valuations will eventually look reasonable. Maybe that happens. It's certainly possible. Technology has transformed industries before. The internet did. Smartphones did. Cloud computing did. AI could become the next major revolution. But before we assume that outcome is guaranteed, let's look at the scale of the bet currently being placed. Because the numbers are staggering. In 2026, for companies alone, Microsoft, Alphabet, Meta, and Amazon are expected to spend roughly $740 billion on AI-related infrastructure. Data centers. High-performance chips. Cooling systems. Electricity. Networking equipment. Storage. Software. Everything required to power the next generation of AI. That's nearly an 80% increase compared to the previous year. And the previous year was already considered unprecedented. To put that into perspective, those four companies are expected to spend more money in 12 months than the annual economic output of many developed nations. 4 corporations. 1 year. Hundreds of billions of dollars. And this isn't a one-time investment. Management teams have made it clear that spending is expected to continue rising. They're building for a future they believe will be enormously profitable. The question is whether that future arrives quickly enough to justify today's costs. Because those costs are already starting to leave a mark. Amazon, for example, is projected to generate negative free cash flow this year, with estimates ranging between negative $18 billion and negative $30 billion, depending on the model being used. In plain English, the company is spending cash faster than it's generating it. Not because the business is failing. Because it's racing to keep up with AI infrastructure demands. Microsoft has also acknowledged that a significant portion of its capital spending increases are being driven simply by rising prices for chips, hardware, and related components. Even Meta experienced investor backlash earlier this year after announcing another increase in AI spending plans. The market's reaction was immediate. Shares dropped sharply as investors questioned whether the spending would translate into future profits. For the first time, investors started asking a simple question. How much is too much? And that's where things start getting interesting. Because the AI ecosystem is becoming increasingly interconnected. One company funds another. That company signs contracts with a third company. The third company raises capital to fulfill those contracts. Then another company supplies the hardware that makes everything possible. Money is constantly moving through the same network of participants. Nvidia supplies chips. Cloud providers purchase those chips. AI companies rent computing power. Infrastructure firms build facilities. Investors fund expansion. Everyone depends on everyone else. The entire system works beautifully as long as growth continues. But highly interconnected systems can also become fragile if expectations stop matching reality. And that's exactly what some investors are beginning to worry about. Because the amount of future spending being committed today is absolutely enormous. Various AI companies have collectively announced spending plans that stretch years into the future and total well into the trillions of dollars. Yet many of these businesses are still trying to prove how those investments will ultimately generate returns. Imagine someone earning $40,000 a year signing paperwork to purchase a multi-million-dollar mansion because they're convinced their income will eventually catch up. Maybe it will. But that's an extremely ambitious assumption. To be fair, supporters of the AI boom have a valid argument. Unlike the speculative internet startups of the late 1990s, today's largest technology companies generate enormous amounts of real revenue and real cash flow. Microsoft is profitable. Alphabet is profitable. Amazon is profitable. Meta is profitable. These aren't companies operating on dreams alone. However, profitability doesn't automatically guarantee that every dollar spent on AI will generate a meaningful return. And that's where recent research begins to raise eyebrows. A study examining hundreds of real-world corporate AI implementations found that the overwhelming majority of organizations struggle to generate measurable financial benefits from their AI investments. Not small returns. Not disappointing returns. No measurable returns at all. Think about that. Companies across the world are collectively spending hundreds of billions of dollars every year pursuing AI opportunities. Yet many are still struggling to prove that the technology is creating meaningful financial value. Eventually, investors will want more than promises. Eventually, they'll want evidence. And when that moment arrives, the market may be forced to answer some uncomfortable questions. Questions it has largely been able to avoid so far. Now let's zoom out from AI for a second and look at the bigger picture. Because expensive markets can stay expensive for a long time. The problem is that high valuations only make sense when everything else is working perfectly. Strong economic growth, falling inflation, lower interest rates, healthy credit markets, confident consumers, stable government finances. When those conditions start weakening, investors suddenly become a lot less willing to pay premium prices. And right now, several of those pillars are starting to wobble. Let's begin with inflation. Earlier this year, inflation came in at roughly 3.9% year-over-year, one of the highest readings we've seen in nearly 3 years. That may not sound catastrophic, but it creates a major problem for the Federal Reserve. Just a few months ago, Wall Street was convinced multiple rate cuts were coming. Investors expected borrowing costs to gradually move lower throughout the year. That expectation helped fuel much of the market's optimism. Today, that outlook looks very different. At its latest meetings, the Federal Reserve chose to keep rates unchanged, and policymakers have become increasingly divided on what should happen next. Instead of debating how quickly rates should fall, many economists are now discussing whether rates might need to stay elevated far longer than expected. Some are even talking about the possibility of additional increases if inflation refuses to cool. That's a dramatic shift in expectations over a very short period of time. And markets don't always handle sudden expectation changes very well. At the same time, leadership at the Federal Reserve has changed. New decision-makers are stepping into influential positions while inflation remains stubbornly above target. Whenever markets face uncertainty around monetary policy, volatility tends to increase. Now let's talk about bonds. Because bonds are quietly becoming a much bigger competitor to stocks. The yield on long-term U.S. Treasury bonds recently climbed above 5%. That's significant. For years, investors had almost no choice but to buy stocks because safe investments paid next to nothing. When cash earned close to zero and bonds yielded very little, taking risk felt almost mandatory. Today, that's no longer true. An investor can earn around 5% from government-backed securities without taking stock market risk. And that changes the math. If a safe investment offers 5%, suddenly paying nearly 40 times earnings for a stock becomes much harder to justify. Every increase in bond yields places additional pressure on stock valuations. Think of bond yields like gravity. The higher they rise, the harder it becomes for expensive assets to keep floating upward. And that's only one side of the equation. The other side is debt. A lot of debt. The federal government is projected to run another massive deficit this year, approaching $2 trillion. Meanwhile, total national debt has climbed beyond $38 trillion. But the debt itself isn't the biggest issue. The interest payments are. The government is now spending over $1 trillion annually just to service existing debt. Not to reduce it. Not to eliminate it. Simply to pay interest. That figure now exceeds many major areas of government spending and continues growing as rates remain elevated. Some of the world's most respected macro investors have warned that this creates a dangerous cycle. More debt creates larger interest payments. Larger interest payments require additional borrowing. Additional borrowing creates even more debt. The cycle feeds itself. Whether you agree with those warnings or not, it's difficult to ignore how quickly the numbers have escalated. Now here's where things start getting really interesting. Because major financial problems rarely appear all at once. They usually begin with tiny cracks. Small problems. Random failures. Events that seem unrelated at the time. Then later, everyone realizes they were early warning signs. Think back to the years before the housing crisis. Before the headlines. Before the panic. Before the collapse. There were isolated bankruptcies. Strange lending issues. Unexpected hedge fund failures. Most people ignored them. In hindsight, they were signals. And we're seeing similar signals today. Over the past several months, multiple companies have collapsed unexpectedly, leaving lenders with hundreds of millions of dollars in losses. Several businesses that appeared healthy on the surface were later discovered to have serious financial problems hidden underneath. Some had significantly more debt than investors believed. Others relied on aggressive financing structures that disguised their actual risk. When those businesses failed, banks and creditors absorbed massive losses. Then came problems within portions of the regional banking system. Several institutions disclosed exposure to troubled loans and underperforming assets. The market reacted immediately. Regional bank stocks experienced sharp declines as investors questioned what other surprises might still be hidden on balance sheets. Individually, none of these events seem large enough to threaten the entire financial system. That's exactly why they're worth paying attention to. Major crises rarely announce themselves with giant warning labels. They start with isolated incidents that nobody takes seriously. One company. One lender. One bad loan. Then another. Then another. Eventually investors realize those incidents weren't isolated at all. Even some of the most influential banking executives have publicly warned that problems tend to travel in groups. When one issue appears, there's often another one hiding nearby. And another after that. So let's pause and look at the scoreboard. Stocks are trading near record valuations. A small group of companies controls an unusually large percentage of market performance. AI spending is exploding at historic levels. Inflation remains stubborn. Interest rates are higher than expected. Government debt continues growing. Bond yields are becoming increasingly attractive. And small cracks are beginning to appear throughout parts of the credit system. The obvious question becomes, what are the smartest investors in the world doing in response to all of this? Because if these concerns were only coming from a random YouTube video, you could safely ignore them. But that's not what's happening. Many of the investors who have successfully navigated multiple market cycles are becoming noticeably more cautious. And what they're doing right now might be the most important signal of all. So what are the world's most respected investors doing while the market celebrates new highs? Many of them are becoming increasingly defensive. Warren Buffett recently stepped away from leading Berkshire Hathaway, and the company is now sitting on a record cash pile approaching $400 billion. That's one of the largest cash positions in its history. Michael Burry, famous for correctly identifying the housing bubble before the 2008 crisis, has compared today's environment to the late stages of the dot-com boom and has positioned parts of his portfolio defensively. Jeremy Grantham, who successfully warned about several major market bubbles, continues to argue that current valuations remain dangerously stretched. Stanley Druckenmiller has significantly reduced exposure to several major technology positions after previously being bullish on them. Now, none of these investors know exactly when the market will peak. Nobody does. But when multiple investors with decades of experience all start becoming cautious at roughly the same time, it's worth paying attention. Even professional money managers are starting to show concern. Recent surveys reveal that a large percentage of institutional investors believe AI-related stocks are showing signs of bubble-like behavior. Many also believe corporations are spending too aggressively on AI infrastructure. That doesn't mean the market crashes tomorrow. It simply means expectations have become incredibly high. And that's where most investors face a hidden risk. For decades, buying an S&P 500 index fund has been one of the smartest financial decisions a person could make. Historically, it worked extremely well. But because a handful of companies now dominate the index, many passive investors are carrying far more concentration risk than they realize. You may think you're diversified across 500 companies. In reality, a large portion of your portfolio's performance depends on a small group of mega-cap technology stocks. You didn't intentionally make that bet. The structure of the index made it for you. At the same time, margin debt remains near record levels, and speculative trading activity continues to surge. Many investors are acting as though stock prices can only move in one direction. History suggests that's usually when risk is highest. Now, am I saying you should sell everything? Absolutely not. Trying to predict the exact market top is almost impossible. Markets can stay expensive much longer than anyone expects. In fact, they could continue climbing for months or even years. But what you can do is understand what you actually own. Review your portfolio. Check your allocations. Ask yourself whether you're comfortable with the amount of exposure you have to a small number of companies. Consider rebalancing if technology has become an outsized portion of your investments. Consider broader diversification. Consider international exposure. Consider bonds. And don't be afraid of holding some cash if it helps you sleep at night. The goal isn't to predict the future. The goal is to avoid being caught completely off guard. Because market tops rarely arrive with a warning. They build slowly. Confidence grows. Optimism spreads. People become convinced that this time is different. And then, suddenly, sentiment changes. That's why one of the best investing lessons ever shared is this. The top is a process. The bottom is a moment. Right now, that process is still unfolding. Stocks are climbing. The headlines remain optimistic. Your coworker is still bragging about gains. Everything feels great. And that's exactly why it's worth paying attention. Because throughout history, the final stage of a bubble has always felt comfortable while it was happening. You don't get to choose when the next major correction arrives. You only get to choose how prepared you'll be when it does. Anyway, that's where things stand today. If you found this video helpful, hit the like button, subscribe, and let me know in the comments what your largest portfolio holdings are. You might be surprised by what you discover. And as always, this video is for educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions. Thanks for watching, and I'll see you in the next one.